Peter, let me start with you. What is going on in the markets? I didn't think what the Fed had to say was that radically different from what we'd heard before, but boy, the market sure reacted this time.
Well, look, in the short run, what the markets are reacting to is their expectation of where interest rates are going to be in 24. Investors believed that the Fed was going to be able to engineer a soft landing, which Powell, again, reiterated he was trying to do, but investors believed that in 24, interest rates would begin to be cut. And the Fed has been a little bit more hawkish on that. The Fed has said, well, there's probably another rate increase this year. And if you look at the dot, which is the explanation of the committee's estimation of where rates are going to be, those dots moved up. And that's what unsettled the market. Now, that's a very short-term activity, but the market reacted significantly to that.
Sarah, at the same time, the Fed, I thought, said, boy, the economy, if anything, looks stronger than we thought it would before. Is that good news or bad news? I mean, if it's stronger than we thought, does that mean actually the Fed will have to keep pushing on the interest rates, which could lead to something breaking?
Likely. It appears the Fed might have underestimated how insensitive the U.S. market is to U.S. economy is to rising rates. There's many corporates, for example, have termed out their debt. So longer duration debt at fixed rate creates a level of insulation to what the Fed is doing. So there may be less sensitivity, but ultimately, as rates remain higher for longer, this will catch up with those who have borrowed too much or where assets prices are falling, thinking in particular about parts of the real estate sector.
Peter, what about the real estate sector? As we don't want anything to break, but it's a decided possibility, I think it's fair to say. Is that what we should be looking at?
So the real estate sector in the economy breaks into two pieces. There's the residential real estate business, which is very large and affects a lot of people. And to Sarah's point, is the part of the economy that is very rate insensitive today, because most mortgages today are fixed rate. And they were fixed at low interest rates. So households today have a big, big benefit. They own a very long liability, or effectively an asset to them, at very low rates, which allows them to continue to spend and gives them positive operating leverage in their daily budgets. In the commercial space, however, that's totally different. In the commercial space, there you had buyers buying buildings at low cap rates and low interest rates, which do need to be refinanced. And there, Sarah, again, is absolutely correct. We are going to see refinancing that is going to cause problems in the real estate business. We've already seen that. We've seen significant owners in real estate over the last 6 months literally walk away from buildings. That's highly unusual.
And this comes at a time when bank credit is tightening, too. So it's a bit of a double whammy.
Well, and Sarah, let me ask you, some people are now saying, forget about the higher for longer. What if it's higher forever? I mean, what if this basically is a new normal, as it were? What does that do to the investment proposition?
Well, cycles don't normally work that way. Our expectation at Causeway is that the Fed will achieve its 2% or thereabouts level of inflation, but that will come at the cost of employment. And as the U.S. economy shifts downward and slows dramatically, that in turn will precipitate the Fed easing. But that might not happen again for quite a while. It could be several more quarters. It could be a year. It could be longer. It's very hard to say. But the longer rates remain high, it's like a slow asphyxiation for those that are over-leveraged. And there's plenty of that across this economy. In fact, there's plenty of that globally.
There might be a slightly different outcome there. Certainly the Fed has said they want to get to 2%. But I don't think the Fed will consciously break the economy to get there. And it may be that we see inflation at 3%, and then the term structure of interest rates, may shift a bit, and perhaps the 10-year isn't going to go down to 3%. It's going to be at 5 to 6%, and cash is going to be at 3 to 4%. And that's not an unusual position for the term structure of rates to be. In fact, over the last 70 to 80 years, it was more likely that than not. And the economy can be just fine there, and stocks can do just fine there. And that, I think, is also a possibility.
Sometimes, Peter, I think we tend to focus on the Fed and the economy, like that's the only two players in the game. There's also a federal government that is spending a lot of money and borrowing a lot of money. What does that mean potentially for the rate structure?
Well, look, that's going to crowd out borrowers on the duration side. And so that is another reason why 10-year rates may not drop back to 3% or 3.5%. The federal government is spending a lot of money. We have three big programs: infrastructure, CHIPS, and other spending programs in climate. Those things are going to continue no matter what. And there's a multiplier effect in those programs too. When you spend money in infrastructure, the government's basically the equity in the infrastructure, and then banks come on top. And so if you have $100 million in an infrastructure project and a bank lends $200 to $300 million, now you have whatever that is, $400 million or $300 million, much bigger than you think. So I think that that stimulus is going to continue. That's going to make it hard for rates to come down. We could have a complete recession, a bad recession. And then, of course, rates will come down, and we will see lower rates. But I don't think they'll stay there.
So, Sarah, what about the world of maybe a 5% 10-year, or even, Peter said, 6% 10-year? If that were the case, how would that change your investment approach?
Well, the higher real rates are great for value investors because that means a discount rate of all stock is worth at the present value of the cash flow it can generate into perpetuity. And as that discount rate rises, it becomes more punitive for really long duration stocks, more speculative. They have their earnings promised and their cash flows way out in the future. So all of a sudden, cash earned today is worth more, which means dividends are more valuable to investors and income up front. So I consider it to be propitious, which is why there have been these moments of value outperformance and what we can see for undervalued stocks. This is true globally, not just the U.S. market. They're showing some significant strength, and I think this is the beginning of a very long cycle as rates remain high. After all, it's 18 to 24 months typically is the time it takes after a rate rise, a Fed funds rate rise, to see an impact. The first rate rise occurred 18 months ago. We've had multiple rises since then. So this story is just starting.
Peter, to what extent is the United States, the markets in the United States, benefited by the fact of what's going on elsewhere, such as China, such as Europe, something? The alternatives may be less attractive to the United States.
Well, certainly for the last 10, 15 years, the U.S. has been the place to invest. China's turmoil is well publicized. Europe has not grown anywhere near the same rate as the United States. And so the U.S. has benefited from that. We probably maintain that edge over time. I think that the U.S. economy is probably the strongest and most dynamic of all of those places. And until we see real stability and, I would say, laws that protect investors being applied effectively in China and not, capricious actions on the part of government, I think the China market will continue to be challenging for external investors.